when we're evidencing gold priced in every single other currency stretching to all-time highs, we saw the dollar gold price decline at the open of November trade. And for us really to draw attention to why this counterintuitive action is the final officially driven, and it is officially driven, kick at the can before we see the only central bank short gold, which is, yep, that's the Fed, forced to revalue gold, which a consensus of first-tier liquidity providers suggests at latest after we enter the physically driven 2024 marketplace.
AndrewMaguire, an independent London metals trader, states a curious market trend where gold hits historic highs in various currencies, except for the dollar. Looking over the last year, the price of gold in US dollars has decreased by 3% as the US dollar has strengthened against other currencies. The key drivers for gold prices in the upcoming week will likely be the US dollar's trajectory and any new economic data that could influence Fed policy decisions. Andrew Macleod believes that global central banks are strategically amassing gold to revalue it close to market prices. Foreign currency revaluation accounts are not used to replenish central bank capital because such unrealized gains may be temporary. Gold, as the only financial asset that cannot be printed, consistently sees its price in fiat currencies rise over the long term, perpetually expanding the size of gold reserves accounts. Global official gold reserves rose by 337 T, 120% higher Q, and the second highest third-quarter total, following Q3 2022. 1. On a YTD basis, central banks have bought an astonishing net 800 T, 14% higher than the same period last year. While Macleod mentions that central banks, in their pursuit of tangible assets, are growing reluctant to adopt U.S. treasuries. Gold prices rose on Thursday as the U.S. Treasury yields edged lower amid prospects that the Federal Reserve is done with its rate hike cycle. Data collected by the U.S. Securities Industry and Financial Markets Association shows foreign ownership of treasuries has sunk to around 30%, down from more than 40% a decade ago. He also points to the gold market shift initiated by the Bank of International Settlements reclassifying gold as a top-tier asset on January 1st. Now, we present the clips of AndrewMaguire insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Kicked off following the Bank of International Settlements revaluing physical gold as a first-tier asset class on the 1st of January, which is when gold began competing against US treasuries. Now, providing central banks, sovereigns, commercial trading advisors, and investors an alternative far superior, zero counterparty risk alternative, safe haven investment and hedging vehicle. Now, during the course of this year, this alternative safe haven pivot sparked the largest central bank sovereign physical gold demand in history, severely impacting available global supply. None of this is seen inside the casino. Market footprints evidences central banks hedging previously unfactored US Treasury tail risk by their actions is already weighing on Treasury demand. It's this lack of Treasury uptake that's actually been spiking the bond yields higher as central banks, alongside institutional investors who have a global view, seek real asset alternatives, which of course include cash, but also gold. And under the Fed's induced smoke and mirrors haze, every central bank, including the Bank of International Settlements, who 1 year ago, almost to the day in November 2022, bought back their entire gold derivative positions, concluded it on that day, taking advantage of the Fed's synthetic attempt to cap the dollar price of gold. Now, note, though, that despite the Fed's best efforts, exactly 1 year later, gold is carving out a higher stairstep, over $350 per ounce higher than the $1,618 point, the exact point the Bank of International Settlements covered the last of their bets against a rising gold price. Look, there's only one reason gold is carving out a higher stairstep to rally from in 2024. Every other global central bank, both Western and the entire global south have been openly on record as well as surreptitiously off record buying physical gold. And this leads to just one conclusion. Global central banks are accruing physical gold so they can revalue this gold at close to the market price. And when any one of these central banks commences this process, it will trigger every other central bank to synchronize. And as soon as this happens, the Fed will have basically one of two options. Either they admit they've sold title to the Treasury gold to multiple parties. Well, clearly that's not an option. Or they're going to have to move to revalue this 831 tons of rehypothecated positions in sync with global central banks so as to avert what would be a foreign exchange imbalance. Bear in mind that gold's a foreign exchange cross. So it would create an FX imbalance, which would trigger multiple repatriation requests from other central banks requiring their undervalued gold to be returned for jurisdictional revaluation purposes. Now, if the Fed does synchronize to also value foreign exchange gold against the dollar, it would be the only way they could maintain their rehypothecation illusion, thereby averting unwanted repatriation requests.
Andrew Macleod stressed the connection between silver and gold, noting silver is more susceptible than gold. After eclipsing $30, silver could challenge levels not seen since its two prior secular bull market peaks in 1980 and 2011, when silver approached nearly $50 per ounce. Silver offers explosive upside potential for investors with the appropriate risk tolerance as the metal enters its next major multi-year upcycle. Furthermore, Macleod pointed out discrepancies in the gold-silver ratio trade, signaling an opportunity with silver outperforming gold once gold is revalued. Silver's use in industrial applications is also the reason why it's been outperforming gold this year. Gold is mainly used for jewelry or as an investment, but silver is a necessity in many everyday applications which has still been around for a while, making it an even rare precious metal. Let's get back to the interview.
And it's in the same hands as the gold actors that we're talking about. And as silver is not yet NSFR compliant, in other words, if you're providing liquidity into the spot market, you don't have to have the physical on hand. It's easier to influence silver than gold. So we look at these market makers' footprints in the gold-silver ratio trade, where silver is benchmarked against gold. So given at 87-1, which it was at the beginning of the week, is so synthetically divergent from where the ratio should be at less than 87 ounces of silver to buy 1 ounce of gold, we see silver as outperforming gold once gold is revalued. This is a hell of an opportunity. Now, looking very short term at silver, the ratio trade is looking attractive at current deeply suppressed silver levels. And while there's little doubt that silver could not be maintain offers to sell below $23 spot into such large Indian and Chinese demand, is also the case regarding speculators held bearish options bet against silver at 24. So really we're seeing the speculators really sort of somewhere gaming between 23 and 24. Following the spec rinsing, the options sweet spot, we're talking about on the 27th of the month, it had lowered between 23 and the base as a base case and 24 as a top case. But given many of the short bets against $23 are speculator held and the house long against them, we may see some further fireworks as we get closer to options expiry on the 27th. Now, liquidity providers are expecting a physically driven turnaround rally. And given December futures expiring this month historically evidence the largest delivery of the year, and it's the only month where both gold and silver futures expire together, our immediate focus is where the COT-derived options sweet spot are aggregated. And the bulk of these December sweet spots were determined up to 12 months ago. And they don't factor in current geopolitical risks undermining these cap bets. As far as gold is concerned, we're currently evidencing the geopolitically driven first first black swan event that also finds gold reclassified as a first-tier asset class. And as we've been observing, following the Bank of International Settlements revaluing physical gold as a first-tier asset class on the 1st of January, gold now increasingly competes against US Treasuries, really trying to draw attention to this. Providing central banks, sovereigns, CTAs, wake-up CTAs, and investors an alternative, far superior zero counterparty risk, alternative safe haven investment and hedging vehicle. And none of these bullish drivers are baked into these soon to expire capped options bets expiring on the 27th of November, going into first notice then on the 29th, into zero counterparty risk NSFR compliant gold competing with high counterparty risk US Treasuries. Now, covering these long-standing, wrong-footed capped bets requires enough speculators to cover into. This is the point I'm trying to make. However, there are far too few specs to short cover into to square up the bulk of this unfactored, physically driven imbalance.
The strategic moves by global central banks to amass gold for a potential revaluation emphasize the precious metal's enduring significance. Macleod's analysis underscores the impact of international events on the gold market and prompts a deeper consideration of the evolving role of gold in the financial system. How do you interpret the changing dynamics in the gold market, considering the strategic moves by central banks and the potential for a revaluation? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.